Welcome to the boardroom. I am your managing director for today's executive briefing. Right now, we are initiating a full-scale C-suite grade proposal audit on one of the most critical, high-stakes metrics in the Cambridge Accounting AS and A-Level 9706 syllabus, the non-current asset turnover efficiency ratio. Listen to me very carefully. We are not just here to casually memorize a formula today. That is what amateurs do. We are here to engineer bulletproof structural frameworks, deploy precise data analytics, and utilize corporate-level evaluative reasoning to optimize your exam performance and pitch your arguments to the toughest stakeholders in the business, the Cambridge examiners. This is about securing maximum valuation on your paper. Let's get to work.
Here is the itinerary for today's audit. We'll start by establishing mistakes, move into core asset principles, outline our technical methodology, execute a critical method mark strategy, conduct a strict compliance audit, and finally close the deal with final valuation protocols.
Section 1. Establishing the stakes.
Let's open this briefing by looking at the raw market opportunity sitting right in front of you. Mastering efficiency ratios and specifically non-current asset turnover is absolutely non-negotiable. This isn't some niche, obscure topic that might pop up once a decade. This appears in nearly every single examination series. It is a guaranteed market opportunity. If you prepare your assets correctly, you walk into that exam hall with high tariff marks already locked in your portfolio. But make no mistake, the examiners are ruthless. A weak structural presentation will instantly crash your valuation and cost you an A-star. You have to treat this with the precision of a high-end corporate merger.
Section 2. Core Asset Principles. Let's define the fundamental assets we are working with here. What are the examiners actually testing? Sure, the core accounting formula for non-current asset turnover is your net revenue divided by the net book value of your non-current assets. It essentially measures how ruthlessly efficient a business is at using its heavy, long-term assets, machinery, vehicles, property, to generate cold, hard sales. A higher ratio generally indicates a leaner, more efficient operation. But Cambridge demands so much more than just robotic formula recall. Let me give you a perfect example from my own team. I recently had two junior consultants, let's call them Alex and Sam, pitching a case study to me. Alex is a walking database. Alex pitched me a massive volume of raw factual data, perfectly reciting the textbook definitions, but completely failed to evaluate the actual market risks of the specific business we were looking at. There was zero evaluation. Then Sam stepped up. Sam is a fast speaker, highly creative, pitching brilliant strategic concepts, but Sam lacked the hard asset backing. Sam didn't cite a single specific case study figure or textbook formula. Both of their proposals were outright liabilities. To get the top band marks, you have to merge those two approaches. You need a connected conceptual understanding through systematic analysis and evidence-based reasoning that you can transfer to completely unfamiliar contexts. You can't just bring raw facts, you have to evaluate the specific business. If you cannot apply the principle to a complex manufacturing firm or a newly acquired retail chain, your conceptual framework collapses.
Section 3. Technical methodology. Now we get into the technical architecture. To succeed in this pitch, there is a strict procedural sequence you absolutely must follow. This is your standardized, non-negotiable workflow. Step 1. Identify the key elements from the provided text and data tables. You are scanning for viable assets. Step 2. Apply the relevant accounting principles. Step 3. Execute the analysis with crystal clear working. We will cover risk management and liability protection on that in just a moment. Step 4. Verify the results for economic reasonableness. Step 5. Present the final package in an appropriate corporate format. Listen to me. If you try to skip from Step 1 straight to Step 5, bypassing the analytical execution just to spit out a final ratio, you are entirely bypassing Cambridge's regulatory requirements. Systematic processing is what creates a bulletproof answer structure that examiners can instantly scan, verify, and award maximum marks to.
And speaking of appropriate formats, let me remind everyone in this briefing that a brilliant analytical pitch loses all its market value if it fails to meet Cambridge's strict presentation compliance conventions. We are talking proper headings, rigorously correct accounting terminology, appropriate tabular or paragraph formats, and clear professional annotations. I have seen candidates write brilliant, boardroom-level insights about asset efficiency, but because they used casual, colloquial language instead of precise terminology, literally saying a company bought things instead of acquired non-current capital assets, their valuation plummeted. The examiner downgraded them instantly. You are stepping into a professional arena. You must speak the precise language of an elite accountant.
Section 4. Method mark strategy.
I want to pause the data feed for a second and ask you a direct question.
Why do candidates consistently find multi-stage analysis and method marks so incredibly difficult? Why do the valuations drop here? It's psychology. When you are under the intense pressure of the exam clock and that audit deadline is ticking down on the wall, human nature is to rush the pitch. You want to skip the due diligence and just close the deal to get the final number. But in doing so, candidates completely abandon their risk management protocols, they perform complex calculations in their head or scribble them illegibly in the margins, leaving absolutely no paper trail. They are essentially trading without a safety net, and the examiners will penalize that heavily.
So, the absolute linchpin of this entire strategy is how to protect your academic assets even when you make a critical, on-the-ground calculation error. Listen to this executive liability warning straight from the Cambridge Principal Examiner reports. Students lose marks by not showing working. Even if your final answer is wrong, method marks can save you. This is your ultimate insurance policy. If you document your architectural process, if you write down the correct formula, physically show the substitution of the specific case study figures, and then, in the heat of the moment, accidentally hit the wrong key on your calculator, method marks act as your failsafe. The examiners will still compensate you for building the correct procedural framework. But if you just write down the wrong final number with zero working, your equity drops to zero. Always, always leave a transparent, undeniable audit trail.
We are heading our mid-pitch valuation reboot. Before we see if this response can secure a top band valuation, ensure your personal academic assets are properly managed. Subscribe to Ace the Exams at the handle @AceTheExams right now and turn on all notifications. No matter if your focus is Cambridge IGCSE, O-Levels, AS, or A-Levels, this channel is your weekly board seat to secure elite grades. Lock it in and let's get back to the audit.
Section 5. Compliance Audit.
It is time for a live interactive compliance audit. Let's isolate the specific liabilities that cause candidate scores to instantly crash. Based on our data extraction from the Principal Examiner reports, here are the top 3 massive exploits you need to avoid. Liability 1. Using the wrong approach for the wrong context. You absolutely cannot analyze a heavy, capital-intensive manufacturing firm's asset turnover the exact same way you would a lightweight, service-based consulting firm. The rules of gravity are different. Liability 2. Forgetting to check format and presentation, which we just audited. But liability 3 is the ultimate valuation killer, answers that are not specific to the context given. If you provide a generic, textbook answer that could conceptually apply to any business on Earth, the examiner will immediately downgrade your proposal to the lowest marking band. Your insights must be ruthlessly tied to the specific case study in front of you.
Let's do a live venture scan and spot the liability on screen right now. Let's look at how Alex and Sam initially drafted their response. Alex came to me with the draft on the left, a low-value response. Alex said, "Look, I put all the data in." But I told Alex, this is just a descriptive text block. It completely lacks business context, and it only states similarities. You are just summarizing the question without actually answering it. A response like this crashes on the marking grid because it fails to satisfy the explicit constraints of Cambridge command words like evaluate or analyze. So I had them rebuild it. I introduced them to a structural power-up template, the PEAL framework: point, evidence, evaluation, link. Sam took the lead on the rewrite, resulting in the high-value asset on the right. Notice the architecture here. Sam used comparative connectives like conversely and however to aggressively pivot the argument. Sam identified similarities and crucial differences between 2 years of asset turnover data. Most importantly, every single claim was backed up with hard numerical evidence extracted directly from the source materials. By transforming a flat descriptive summary into a multidimensional comparative pitch, they secured the A-star valuation.
Now, to maintain that elite level of performance under strict time constraints, you need immediate data retrieval. You need a mental framework. Here is your actionable asset management hack. Memorize the acronym A.E to recall the factors affecting efficiency ratios. A stands for age of assets. Are they running ancient machinery that breaks down constantly, bottlenecking their revenue? D stands for depreciation policies. Did they suddenly change how they value their assets on the books, artificially inflating the ratio? E stands for expansion. Did they just acquire a massive new warehouse at year-end that hasn't even begun generating sales yet? Having this ADE architecture in your head allows you to instantly draft your structural outline before you even write your first sentence.
Section 6. Final Valuation. Let's secure the deal. We are nearing the end of our compliance audit. It's time to finalize the critical thinking protocols required for top-tier C-suite marks. Look at the matrix on screen. These are your 3 evaluative thinking pillars.
First, questioning. You must relentlessly challenge underlying assumptions. If the asset turnover ratio drops, an amateur assumes the company is failing. A master questions the data. What if they just purchased highly efficient next-generation machinery right at the end of the financial year? The asset base increased, but the revenue hasn't hit the books yet. Second, perspectives. You must consider alternative interpretations. Analyze the data from multiple angles. How does this look to an aggressive external investor versus a cautious internal supplier? Third, justification. You must support every single strategic decision with hard, undeniable evidence from the case study text. You do not guess, you prove. This exact matrix is how an elite candidate evaluates evidence quality and makes highly justified recommendations.
Let's summarize the entire session into one final, continuous operational loop. This problem-solving deconstruction algorithm is your ultimate review checklist. Whenever you face a high-tariff, multi-part past paper question, run this exact sequence. Step 1 is your due diligence scan. Identify the given information. Step 2 is your resource allocation matrix. Break the massive problem into logical, bite-sized analytical steps. Step 3, solve systematically, projecting every line of working onto the page to secure those vital method marks. Step 4, check for reasonableness. If your calculated turnover ratio is 500 times, does that make actual economic sense? Or did you drop a decimal point and create a massive liability? Step 5, your final compliance audit. Make justified recommendations utilizing your evaluative pillars. If you run this systematic algorithm, you guarantee full compliance with the marking scheme.
At the end of the day, a business is only as successful as the ruthless efficiency of its assets. The next time you audit a company's balance sheet, I want you to ask yourself, are their assets actually working for them, or are they just gathering dust? Your executive briefing is complete, but the real work starts now in your independent practice. Subscribe to Ace the Exams at the handle @AceTheExams, enable the notification bell for weekly board sessions, and drop a comment below stating your target grade, qualification tier, and subject. Commit to your goals, publicly, aggressively practice those past papers, maintain your structural frameworks, and I will see you in the boardroom for our next masterclass.